Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining us this afternoon, we have Chuck Fuller, Portfolio Manager at Nasdaq Dorsey Wright, Sanjana Prabhakar, Senior Specialist at Nasdaq Global Indexes, as well as Julie Biel, Chief Market Strategist at Kayne Anderson Rudnick. We're here to discuss asset class rankings and the role of the active manager in what's been a dislocated market. It is great to have all of you back with us. Welcome back to Trade Talks, Chuck. I want to kick it off with you. Certainly, the composure of the market has shifted since we last spoke in March. Have we seen any movement with the asset class rankings? Anything notable?
Yeah, we have. So for the first time in a while, really since late 2023, we've seen U.S. equities be dethroned from the number one rank. They're at number two now, with commodities actually at number one. And obviously part of that's going to be, the way that the equity markets fell, over the last, especially the last couple of weeks. But it's also been, because commodities have been so strong during this period as well. You figure, especially with things like precious metals, and gold and silver, especially, it's just been up incredibly. Gold's up almost 30% year to date, and silver's not too far behind. So it hasn't just been the story of the equity markets falling, but also just the strength in commodities.
Yeah. And Julie, you had pointed out in your notes that market timing is always a futile exercise, but it's especially challenging in this particular environment. In fact, drawing on a historical quote from last week, I mean, so much happens just in a week right now in terms of how challenging it has been and understanding what the end game is.
Yeah, absolutely. I think in most cases, we just don't believe in the ability to market time. But I think this is just particularly true. If you are trying to position a portfolio for perfection, for a specific outcome, you need to know not just what President Trump is going to do, you need to know how other nations are going to react. You need to know how capital allocation is going to happen at companies. You need to know how consumer demand is going to change. And I think that that's just deeply not knowable. It's always an uncertain market, but now it's a colossus that we're facing. And so we think that you're always better served being diversified, being focused on quality. You may underperform in the most go-go markets, but you're going to outperform over the long term.
Right. And that's reflective of what Howard Marks had said just last week.
He said, there is no place you can look, there's no analysis you can do to determine whether today's asset prices are right for the environment ahead. It's always true, but I think it's especially true right now. And I think all of these economists, I really feel for them. You had the Goldman Sachs economists talking about a recession risk when the reciprocal tariffs were announced of about 60%. And then Trump pulled back on those and he had to knock that down to 45%. And I say to myself, what is the use of this forecast, right? If we have to knock it up and down this much, I think it's just really a reflection of how difficult it is to try to put numbers on a lot of these outcomes.
Yeah. And Sanjana, you made an interesting point in your notes. It's almost like Liberation Day is the demarcation line, right? It's really all been predicated on what happened in early April.
Yeah, I would agree with you. I mean, if you look at the performance of major indices post-Liberation Day, I think it really speaks to how volatile the markets have been. I think it's safe to say the risk-off sentiment increased post the April 2nd tariff announcement, with global markets also coming under stress. If you look at the MSCI World ex-US Index, it lost 2.3% in the 2 trading days following April 2nd, while the S&P lost 2.5% and the NDX lost 4%. And if you look at the days before the April 2nd announcement, so pre-Liberation Day, global markets were actually relatively immune. You had the Euro Stoxx 50 index up 14% year to date, and the MSCI China index up 15% year to date. So I think that speaks to your point about the Liberation Day being sort of a demarcation point.
Yeah. And Chuck, when we think about valuations prior to the uncertainty that's developed in the US markets, international markets, particularly Europe and emerging markets, were significantly outperforming the US because investors were looking for value within the market, considering the multiples that the US market was trading at. What are your thoughts behind that? It really was a valuation play at the end of the day.
Yeah. I mean, international, and it's been this way for a while, has been much cheaper than the U.S. So I think that's part of it. Another big part of it has just been the dollar. It has just been falling for a while now. It actually took out multi-year support here recently. It's at levels last seen in 2022. So that obviously provides a tailwind for international equities. And really, you've seen a lot of emphasis on Europe. That's kind of where the most of the returns have been, and also Latin America. You've seen a lot of good returns there. Asia, not so much. They're actually lagging the indexes, or at least the international indexes right now, and we'll have to see if that can stay that way.
Yeah. And Julie, what's so interesting is despite the volatility in the market, we saw the best one-day return in history, which makes it even more challenging. So when you're thinking about what sectors, what types of companies you want to allocate resources to, are you just going back to basic fundamentals and who's operating the best way that they can in this kind of environment?
Yeah, absolutely. Because I think even if you're trying to overexpose yourself to certain sectors, you're again trying to predict the future in a way that's really difficult and challenging. And I think you're much better served to focus on just the best quality of companies that you can find and diversifying among different sectors. It's really challenging when you're in active management. Clients will call me and they'll say, "Oh my God, what are you doing with all of the changes?" And the answer is, I'm really not actually doing that much. I'm paying attention and I'm thinking about how tariffs are going to impact my companies, but I'm not making wholesale changes because broadly speaking, most of our strategies at Kayne are outperforming their benchmarks. They're protecting on the downside, which is what we really believe in. And what I'm really trying to do right now is not make any big mistakes. This is when most portfolio managers make the most mistakes because there's a lot of emotion, there's a desire to be right. And I think that's actually what creates a lot of problems for most portfolio managers is they really want to skate where the puck is going rather than actually knowing what they own and having conviction in what they own.
Yeah, and that's to be a challenge for an active manager to be forced to sit on your hands, if you will. But it's not like, okay, a bottom is in. It feels as if it's orderly. And it might be time to, dip our toes back into areas that have been performing well. I mean, you see, the oscillations of what takes place in the market every day. I can't recall, another time where we saw such significant round trips. I mean, if you think about .com, you think about the 9/11, GFC, it was discernible in terms of what the issues were and the end goal, right? We understood that there's a way that you have to collectively execute to get there. And I think that's what the challenge is.
Yeah, I think a lot of what we're seeing in this market today is that there were so many people at the very beginning of the pandemic in March who really ran for the exits, got themselves in cash, and then missed that rally. And so I think everyone is terrified of making that same mistake again. And I think that's why you see such strong bids on up days, is that people really want to say, aha, I caught the bottom. But I think it's really difficult to know if we're really positioned for that, right? The last time we had tariffs, we saw markets decline, broadly speaking, 20%. These tariffs are maybe 10, 20 times larger if we kind of take the end game of the reciprocal tariffs, and we've declined less than that. So I think there's still room for declines. I'm not predicting that, of course, but what I think is really important is you want to be fixated more so on quality than actually timing, because that's really not what's going to enable you to have long-term returns.
Right. And especially, there are a generation of traders and investors who have not experienced a prolonged period of volatility. I mean, from a historical perspective, COVID was essentially, a blip on the radar if you look at it from a longer term chart. But this it appears that this is going to be a little bit more longer term than what we've experienced in the past 10, 15 years. Plus, the liquidity environment has certainly shifted to not quite as accommodating. So that's another element that newer investors have to contend with.
Absolutely. I think that that's something that people really need to keep in mind is that most investors were not even around when we were in a period of higher interest rates. And so that is a completely different regime to be both in a more austere fiscal situation, but also having interest rates at a much higher level. It's a very different game to play. And I think a lot of us would love to pat ourselves on the back and be like, God, we're such genius for these markets over the last 30 years. But we've really been beneficiaries of low interest rates. And to not factor that in, it misses a little bit the forest for the trees.
Yeah, it certainly does. So Sanjana, when you think about multiples coming down and where these stocks get to be more attractive. So let's take Mag 7 as an example. Is there anything you can tell us from a historical perspective in terms of multiples and valuations, whether you're seeing it in the Mag 7 or anything else that's striking within the indexes?
Yeah, absolutely. I mean, if you look at the Max 7 and specifically the forward PE, you can see that it's declined to 22 times from 31 times at the start of the year. So that marks actually the cheapest level since January 2023, before the AI investment theme even gained traction. And keep in mind, the Max 7 drove much of the market gains over the past 2 years. And if you consider that it has declined this year, I think that's caught everyone by surprise. We see the Max 7 sort of caught in crosshairs. Several of the sectors that they operate in, including electronics, semiconductors, server infrastructure, these areas which are dominated by the Max 7 are at the center of new tariff lists. And I think we have to wait and see how this all pans out.
Yeah, we certainly do. So, Chuck, from your perspective as a portfolio manager, and your style is different than Julie's, you're more factor and rules-based in terms of your methodology. How are you thinking about this when it comes to clients and what their expectations are, or are you waiting for more clarity in the market?
I'd say it's similar to Julie in the sense that we have a process and we're following it. Ours may be more quantitative or factor related, but it's the same kind of thing. We're going with what the rules are for our particular strategies, and just really focusing on executing and not getting too bogged down into, what's Trump saying today, what's he saying tomorrow, that kind of thing. Because, that's up to, like you said, it's up for anybody. You never know what he's going to say on any given day. So it's no sense trying to predict it.
Well, it's interesting because we've asked other technical strategists that have joined us on the show, and because the deviation of the moves have been so dramatic, does from a technical analysis perspective, does that change your style? I mean, it could trigger a rule, and then within a trading session, it could trigger another rule. So, is there flexibility there, or how are you thinking about it when indexes get to a certain level?
Yeah, I mean, and ours are more kind of like end of day versus intraday, so we don't have that kind of an issue. But with what we're seeing here, I mean, obviously, volatility spiked to levels we hadn't seen since COVID, before that 2008. So it's been a rough go. And I would say that the market is very oversold here. And so, it started to come back a little bit, but still, we definitely have more room to run. That's not to say it can't get worse, before it gets better. Sometimes you see that. Sometimes we come down and retest. I'd say that's probably the more the usual way to do it, just to really scare people. But like I said, we're still very oversold here. I think the question now becomes, does is the bull going to turn to a bear? Right.
Right.
And that's,
No.
yeah, that's where we're kind of looking right now. And, like I said, we're very oversold. Typically, when you get this oversold while you're still in a bull, you may see, kind of, different trend indicators turn over. A lot of times it's kind of a false reading when you go down this much before you kind of move over. So we're kind of looking at that, but so far, looking at a lot of the things we're looking at, the positive trend is still intact, but it's close, right? We're not far from moving to negative trends.
Yeah, it certainly is close. But Julie, I guess my concern longer term is we have kind of been we're the beacon for the best capital markets and a trusted trading partner, almost, safe haven, if you will. There are concerns that there's damage that will be really difficult to reverse. So I wonder, what your thoughts are longer term. Could that potentially be a real factor as it relates to the U.S. markets?
Yes, absolutely. I think this is probably my primary existential concern with what these tariff negotiations are going to lead to. In the near term, I think it creates a lot of volatility, but there are a lot of smart people across the world. And what I worry a lot about is that we have established ourselves as an unreliable trading partner with changes made day to day. And most companies, when they're faced with that, they decide to usually X out, because uncertainty is the thing that makes it very difficult to make large capital decisions, large hiring decisions. And so what I worry a lot about is that a lot of countries will just say, you know what, never mind. We will trade with other partners. We will strengthen our relations in Europe. We will strengthen our relations in Canada, Latin America. There's still a big world out there. And that we really diminish our power, both as a trading partner, but also as a consumer. And that creates a place where we are really diminished in our ability to be on the world stage. I look at a lot of the pullback in spending and things like USAID, and I think that was really the goodwill that we were building across the world that enabled a lot of the economic growth and expansion. And what I worry about is that we've basically just kind of spent all our airline miles on a trip we didn't even really need to take. That is to say that we've really blown all this goodwill, and it's not clear to me that what we're going to get in return is more economic growth, more manufacturing. It's a real challenge for me to see what the strategy is long term.
Right. Well, and then of course you have to think about alliances that will be made in, emerging markets that do have a lot of opportunity. I think the paradox in my head is when we traditionally talk about emerging markets, one of the risks has always been geopolitical uncertainty. Guess what? One of those risks are associated with us now. So when you think about other areas of the world where you're seeing significant Chinese institutional investment, Eastern Horn of Africa is a perfect example, right? You don't want to, if you want to be number one in innovation, you certainly have to foster that.
Absolutely. And I think that that's really what we saw actually in the first round of tariffs, where China really strengthened its relationships with its Asian neighbors. And to see that level of collaboration after, I don't know, thousands of years of war is kind of notable, right? We should all kind of take note of that. But I think it's a real reflection of, wow, the economic drivers may actually be closer to home and the ties could be with other countries. I worry a lot because we as a country are not really that comfortable taking on a lot of pain. But, in China, they will eat bitterness for breakfast. It's like that is the thing, is that many countries are much more accustomed to having to do belt tightening for the sake of national goals. And we don't have that culture. And so I worry a lot that there are going to be other places in the world, not just China, who recognize, you know what, we would like to have more reliable trading partners with alliances that we broker and believe in. And if it means that we have a little bit less economic output, but we have more certainty, then we're willing to do that. And that's what I think the real risk is of where we are right now.
All right. Appreciate everyone's insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.